Ladies and gentlemen, good day and welcome to the Q3 and 9 months FY26 earnings conference call for Windlas Biotech Ltd. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Omkar Sawant from Stellar Investor Relations. Thank you, and over to you.
Thank you, Yashasri. Good afternoon, everyone, and thank you for joining us today. To discuss Q3 and 9 months FY26 business performance, we have with us senior management team of Windlas Biotech Ltd, represented by Mr. Hitesh Windlas, a Managing Director, and Ms. Komal Gupta, CEO and CFO. Before we proceed with this call, I would like to mention that some of the statements made in today's call may be forward-looking in nature and may involve risk and uncertainties. The company also undertakes no obligation to update any forward-looking statements to reflect development that occur after the statement is made. Documents relating to the company's financial performance, including the investor presentation and press release, have been uploaded on the stock exchanges and company's website. I now hand over the conference call to Mr. Hitesh. Thank you, and over to you, sir.
Thank you, Omkar. Good afternoon, everyone, and thank you for joining us today for our financial results for quarter ended 31st December 2025. We have uploaded the press release and investor presentation on our website as well as on the exchanges. I hope that everyone must have gotten an opportunity to go through it. Initially, I would like to discuss the outlook and way forward for Windlas Biotech, followed by financial highlights for Q3 and 9 months of the company, which will be shared by our CEO and CFO, Ms. Komal Gupta. India's healthcare budget has crossed rupees 1 lakh crore, signaling stronger support for health infrastructure and affordable treatments. Chronic and subchronic therapeutic segments are expanding rapidly due to lifestyle shifts, dietary changes, and rising medicine consumption. Our expertise in fixed dose combinations and modified release formulations positions us well to cater to this growing demand and support India's evolving healthcare needs. The Indian pharma market grew 11.8% YOY in Q3 FY26 with volume growth of 1.6%. Against this backdrop of modest industry volume growth, Windlas Biotech delivered another strong and consistent quarter, achieving record revenues with YOY growth of 19% in 9 months FY26 and 20% in Q3 FY26. We remained focused on creating value for our stakeholders. For the first 9 months of FY26, the company reported an earnings per share of rupees 24.02, reflecting 12% YOY increase. We continue to invest in strengthening our manufacturing infrastructure. Our injectables and plant-to-extension facilities are paying off with rising contributions to overall growth. And Plan 6 is progressing towards mechanical completion by end of FY26. Looking ahead, we remain focused on creating long-term shareholder value through disciplined execution, diversification of our client base, operational efficiencies, talent development, and expansion across dosage forms. I will now request Ms. Komal Gupta, our CEO and CFO, to discuss the financial performance highlights. Over to you, Komal.
Thank you, Hitesh. Good afternoon, everyone. Our highest ever quarterly revenue streak holds steady for the 12th quarter. Company reported YOY revenue growth of 19% in 9 months FY26 and 20% in Q3 FY26. with revenues from operations of rupees 666 crores and 233 crores respectively. This reflects our disciplined execution and robust performance aligned with stringent quality and regulatory norms. The budget reaffirms healthcare and pharmaceuticals as strategic national priorities, and the company is strategically positioned with our focus on quality manufacturing and scale to leverage estimated sectoral growth opportunities. Generic formulation CDMO vertical grew 20% in 9 months FY26 and 23% in Q3 FY26, driven by expanding customer base, increasing wallet share, and new product launches. Trade generics and institutional vertical grew 18% in 9-month FY26 and 7% in Q3 FY26. We remain focused on delivering accessible, affordable, and authentic medicines across our target geography of Tier 2 and Tier 3 towns in India, while also leveraging increased footprint of institutional purchase programs like Jan Aushadhi. Exports vertical grew 29% in 9-month FY26 and 36% in Q3 FY26 with increased penetration to ROW and semi-regulated markets. Excluding the impact of ESOP expenses, EBITDA for 9-month FY26 was rupees 89 crores, 13.3% of revenue, and PAT rupees 60 crores, 9%, while Q3 FY26 EBITDA stood at rupees 32 crores, 13.6% of revenue, and PAT rupees 22 crores, 9.6%. For 9-month FY26, company reported EBITDA of 79 crores and PAT rupees 50 crores. For Q3 FY26, reported EBITDA was 24 crores and PAT was 15 crores. Our focus is on creating sustainable value for all stakeholders by delivering affordable, high-quality medicines. We are committed to strengthening organizational capabilities that align manufacturing infrastructure, product strategy, and high-performing teams. We will continue to deepen customer partnerships, expand our product portfolio, de-risk the business, and reinforce operational and financial discipline. That's all from our side. We can now begin Q&A session. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We'll take a first question from the line of Aniket from CR Kothari Sons and Stockbroking. Please go ahead.
I hope am I audible.
Yes, please go ahead.
First of all, congratulations for such good numbers, 9 months. My question is, I have two questions. First one is, I wanted to know much more about any upcoming capex which you guys are planning and related funding mix, and what kind of number it would add to current revenue capacity, which is around 1100 crores.
Thank you, Aniket. In terms of capex, our plant 6, as you are aware, we are about to complete plant 6. Mechanical completion is expected to be completed by end of FY26, on which the expected capex is about 50 to 60 crores. Most of it is already incurred. In coming period, about 10 odd crores should get added. So other than that, the maintenance capex of about 15 crores continues. So this is with this we would reach 1000 CR revenue capacity from all the plants, excluding injectables. And from injectables, we are talking about 100 crores additional. Having said that, there is also upside possibility through efficiencies like we have worked in past. So these are the known capex right now. Beyond that, as we approach good capacity utilizations in injectables, we can, so we have decided by then either we get an acquisition opportunity or we start building on a new dosage form. So we would announce something once we have, once we start investing and spending money on something beyond this.
Okay, and thank you for clarifying. And my second question would be regarding, are we expecting any like US FDA or EU GMP visits anytime soon for the plant 6, as it is already near mechanical completion?
No, as you know, Aniket, we are not targeting the US market, and even plant 6 has been added to primarily support all three verticals, and as you know, more than 95% sales we are doing to India. So the utilization of Plant 6 will also be more focused towards India, and then it will gradually support the other verticals also. So we are not looking at USA or Europe for Plant 6.
Okay, thank you so much for clarifying, and I'll join back to the queue.
Thank you. Ladies and gentlemen, in order to ensure that management is able to answer queries from all participants, we request you to restrict to two questions at a time, please. You may join back the queue for follow-up questions. We'll take our next question from the line of Dhwanil Desai from Turtle Capital. Please go ahead.
Hi, good afternoon, everyone, and congratulations for very good execution and very good numbers. So my first question is, on the trade generic side, I understand we can't look at this from a, QOQ perspective, maybe more importantly, 9-month basis also, it's growing at 18%. But, we are in that 45-50 crore range for last few quarters. So, do you think we need to have a slightly different playbook to continue to grow at 25-30% from here on? What are your thoughts on that, and how do you look at this segment, for next couple of years,
Sure. See, as you know, we remain very positive about growth potential in TGX and institutional verticals in the long run. This is driven by, several things: macroeconomic factors, the patient level economics, because the savings that a patient gets, when he buys trade generic products, and Windlas's own strategy, which we have talked about as authentic, affordable, accessible. So AAA kind of a strategy. And I believe that growth in this vertical is, driven by geographic expansion, adding more products, portfolio expansion, and addition of new institutional accounts with a strongly aligned sales force. So we continue to consistently work on these fundamentals and chase our growth aspirations for this vertical.
Okay, got it. Second question is, I think we have done very well on the CDMO and export side. So two parts to that question. One, injectable, you said that, it's been helping us in growing this segment, So, how should we look at it? Should the utilization continue to improve, and hence the CDMO growth should be, slightly higher than 14-15% that we have been doing? And on export side, post, approval from, Philippines, how should we look at, export growth going forward?
So Dhwanil, as you're aware, we refrain ourselves from giving future guidance, either overall revenue-wise or bottom line-wise or even, vertical-wise breakup. But we continue to stay positive on all three verticals, and we see that there is growth opportunity in all of them, and we want to continue to focus on our efforts to open more horizons and to ensure better execution, and that is where we want to leave it. The results, we believe, must follow.
Just one request, ma'am. I understand you don't want to give any quantitative guidance, but at least qualitative color on some of these things would be really helpful in, getting better understanding. That's the only request I have. Thank you, and wish you all the best.
Yeah.
Thank you. Go ahead, ma'am.
Yeah. In terms of qualitative color, so there are few things, Dhwanil, that we cannot say because of the competitive reasons. And then there are others that we are working on, which we don't want to unnecessarily confuse our investors by mentioning them until we see the results coming in. Because, honestly, there are several factors in exports that we are working on, but the kind of results that we get are binary or, time taking in that. So we might be at 70% and then we get to know this is not working out. And then there are others which we don't expect and they happen earlier than expected. and in terms of exports. And in CDMO, we have been mentioning that we continue to work on the long-term growth strategy, where we want to continue to increase our customers. We want to continue to increase the product portfolio. We want to look at the pipeline products and spend money there. And we want to increase our business development teams to be able to execute much better. So we continue to do that. And the results might vary in a vertical or in a short period or in a quarter, but we continue to strongly work on the long term picture, and we want to continue to focus on all the growth drivers, the ones that we have been mentioning even since before IPO. So that continues.
Got it, ma'am. Thank you.
Thank you. We'll take our next question from the line of Gautam Gosar from Monarch AIF. Please go ahead.
Hi, sir. Thank you for the opportunity and congratulations on good set of numbers. So my first question is on the CDMO business. So I think this quarter we saw a strong growth in the CDMO business. So I just wanted to break down this growth. So can you help us understand the volume growth for the quarter as well as 9 months? And majorly, was this growth driven by a higher contribution from the injectable business, or was it completely volume driven?
So, thank you, Gautam. One thing that we can share, Gautam, is that most of our growth comes from volume, right? Because we are a cost plus business, and API prices are not increasing. So the growth is primarily volume oriented, and for sure there is improved contribution from our injectable facility as well as from our plant 2, which extension which we commissioned in the late last year. So definitely those actions that we had taken, the investments that we had made, are lining up in the right direction. So this is something that we can share. In terms of numbers and all those, as you know, we have remained we have chosen not to give breakups on those, because that tends to confuse rather than clarify a picture. So.
Okay, but any number on the volume growth per se in this quarter?
Yeah, volume growth has been more than it was in the earlier in H1. That is true. So, and volume growth is more than the revenue value growth.
Okay. And my second question is on the plant 6. So you said that the mechanical completion will get by FY26. From when can we expect the commercial operations of this plant, and when the revenue flow will start from this plant?
See, like we did in plant 2 extension, we will start taking some benefit through in between fixes in terms of using the machinery required until we are clearly completely able to use 100% of plant 6. There can be partial contribution already, it can start coming in through various ways. But net in first half of FY27, we should be ready to also do the commercialization. Exactly when is what we are figuring out.
Yeah. Okay. Of course, we are always pushing for earliest rather than later, but the stages are mechanical completion, and then quality systems validation, and then finally customer audits. So all those 3 stages have to go for every new facility.
And we are trying our best to ensure that does not become any constraint to our growth. So yes, that we would ensure.
Understood. Fair. And last question, just a bookkeeping question. What would be a net cash position as on 9 months?
I'm sorry, can you repeat the question?
Cash flow generation, because the balance sheet is not audited in limited review, we want to refrain from mentioning those numbers, but there is improvement versus H1.
Okay. Thank you and all the best.
Thank you.
Thank you. Next question is from the line of Avnish Burman from Vicaria Change LLP. Please go ahead.
Yeah, hi. Hi, Hitesh. Hi, Komal. Thanks for taking my question and congrats on a good set of numbers. My first question is on, if you look at the IPM growth, December has been kind of a turning month. I mean, we saw a very strong value and volume growth in December. Can you qualitatively give your sense about why did that happen? And the volume growth, is it possible to split that into chronic versus acute?
I think, first of all, thank you, Avnish. I think that, in fact, in our side, we have been thinking why the industry volume growth has been so muted, right? We have been also discussing around whether the data capture is full around, especially, government programs like Jan Aushadhi and Ayushman Bharat related purchases. Is that even being captured by the industry data reporting agencies like IQVIA and AIOCD? So, I mean, of course, but regardless, even if, let's say, the volume growth represented by the reporting agencies is, has been what it is. In the past several quarters, this has been in the negative. Now it is coming to 1.6%. So, I mean, I don't know if we can say that huge change is there, right, in Q3. But I feel that, with rising income levels, with, more lifestyle issues in terms of food consumption, and also improving access, the overall consumption has to grow in volume terms. And it's more a matter of probably, when the data starts getting reported clearly, or if it is real data, then actually these things, looking to look better. So, I mean, not a very clear answer, but that's, my take on what the industry numbers are showing.
No, that was great. Thanks. Just one question for Komal. Komal, can you just tell us what are your top APIs? Let's top 4-5 APIs in terms of volume that you consume.
Giving away names of APIs would be difficult, but we can say that top 5 or in fact top 10 contribution overall in our purchases would not be more than 5%. So really it's not, and they keep changing. So it's not valuable information from your perspective also.
Okay, understood. Just one bookkeeping question. When do we start seeing the depreciation coming in from Plant 6? From which quarter? And how much is it expected to increase by, let's say, the current quarterly run rate of 7.6, 7.7 crores?
Exact timing, as we mentioned, we are working on that, but in next year H1 sometime we expect the capitalization to happen, and then so either Q2 starts having the depreciation or Q3. I don't know exact timing. And about how much, like it has happened in past with us. Initially, our depreciation levels are higher because we follow WDV method. So if you consider 60 CR capex, accordingly, how it works out in terms of breakup of plant and machinery and everything, we need to figure that out in detail. But broadly, you can consider maybe 60 crore per annum into 60 CR into say 15 to 18% somewhere. I don't know. Initially, that should be the number. Annual.
Okay. I have a few more, but I'll get back in the queue. Thanks for this.
Thank you. Next question is from the line of Avnish Tiwari from Vicaria Change LLP. Please go ahead.
Hi. This export business you have done very well. Is there any thing you noticed as a driving factor, despite the fact that macro level there are uncertainties, although the FX is beneficiary because the rupee has appreciated. So just articulate what are the positives and negatives you are seeing, I mean, with these deals, although they are US and Europe, but anything you find in your end market, what kind of experience you are having, either positive or negative?
Avnish, so as you correctly mentioned, and I want to just reinforce, we have zero sales to US and zero sales to Europe, right? So, and of course, also the tariff issues, pharmaceuticals or generic pharmaceuticals from India were exempted from there. So, but in the markets that we are operating in, which is the ROW markets, which include Southeast Asia, CIS, Africa, it has been business as usual. No real big changes have been happening. So the customers, the products, they're all working on a very long cycle time. So whatever you register, we register for. It takes a long time to get approved, and then so the connection, the customer relationships as well as the product overall viability is not very short-lived. It is actually quite healthy. So, and we have not noticed any large changes or things like that. Even the forex rates have been changing, yes, but are cost plus in exports also. So we have not seen much impact. Export clients also don't go after immediate revisions of POs and things like that. They are quarterly based kind of orders and things like that. So nothing very consequential to really talk about.
Yeah, and in fact the positive results coming in are result of a few factors that we explained 2.5 years back, like getting South Africa or audit clearance, or starting having one customer there and things like these. So this is part of one of the few successes against a lot of efforts that have been going in.
Great. The second question I had was that the growth you are seeing in CDMO space, which is much higher than the industry volume growth of your end market. What is driving that lately, especially? Is it that high-end specialty kind of drugs these days are outsourcing, or is it mostly they are moving into more high-end and they're outsourcing more into the lower-end side, and with this whole Schedule M compliance, you tend to gain because you are a better quality manufacturer? Or something else you want to point out?
So I think, Avnish, it's a combination of the things that you mentioned. Schedule M compliance, better delivery, on-time delivery to customers, greater business development team and alignment of that team, motivation of that team, and our execution on supply chain, manufacturing lead times. So it's a combination of all these things, and so hard to break it up into any of these, but for sure what I can say is that the alignment of all these factors has to is what we try to push for.
And typically outsourcing is at the low-end medicines, or it's a high-end medicine also you are seeing some outsourcing to you from these marketing companies?
We think it has always been both low and high end. We don't think that there is a change in the pattern, but at least the top 4-5 CDMO players have always been getting a combination of very complex and difficult to crack drugs, as well as a few just volume products. From our side, we like to have more complex ones in comparison to the simpler ones.
Okay, but there is no change in mix you are observing, let's say 9-month 26 versus 9-month 25, in terms of mix of these medicines, in terms of complex versus the less complex ones?
So product mix keeps changing actually, but it is less to do with how CDMO players are able to get the business from them instead of how they have changed their outsourcing pattern is what we are saying.
Okay, okay. It's up to your capabilities rather than their decision to decide the mix.
Right.
Yeah.
Okay, great. Thank you.
Thank you. Ladies and gentlemen, we request you to restrict to two questions at a time, please. The next question is from the line of Deepak Kumar from Kalyani Family Office. Please go ahead.
Hello. Yeah, congratulations on the wonderful result, and thank you for the time for the question. So, just one thing. Of course, the management is mentioning that you should have a more of a longish term picture. On the trade generic front, I just want to ask, I mean, of course, growth was a bit muted in trade generics in this quarter. So, what were the reasons for that?
If we look at the last say 14 quarters since FY23 first quarter, we have delivered YOY sales growth of the lowest has been 14%, and there have also been quarters of 74% in various quarters. And as we mentioned that these quarterly variations are incidental, and there is also a portion of institutional orders being lumpy in nature. So, but net, we continue to be optimistic about this vertical, and we believe that we are advantageously positioned in the marketplace. So, not strategic or a change, so to say, in long term.
Okay. And also on the cash, of course, the balance sheet is under limited review, but I presume the cash conversion cycle overall lies around the same range, like 14 to 15 days around which you operate.
Yeah, not mentioning the exact number, but there's no negative change, no negative surprise by December.
Okay, got it. Thank you. I will rejoin in the queue.
Thank you. Next question is from Vilay Rai from Kamaya Wealth Management. Please go ahead.
Congratulations, sir, on a great set of results. Sir, can you share some qualitative insights on how scheduled implementations are panning out? Although these are early days, but have we seen more inquiries from pharma players? And how do we see the consolidation of industry going in the future?
Yeah, sure. As you know, the new Schedule M was published almost 5 years ago, and even when we were coming to IPO, we were talking about it having a big impact on the industry. And the government has also had a very strong enforcement of the Schedule M. So, all the companies above, I think 200 crore or 250 crore revenue were supposed to, follow it already. And then the smaller enterprises were asking for increase in time to give them more time to comply. But even this, I think this last quarter was probably, I think maybe even October or some December time frame, no more extensions were granted. Now everybody is expected to comply. So the government is very serious, the regulator is very serious. A lot of inspections have been done. Some plants have been, given observations, and closures have also happened. In the overall scheme of things, if you see, just from the perspective of how many CMOs are needed to really handle this market, it's certainly not 13,000 plus, right? There is no reason for the CMO industry to stay at this kind of a fragmented level. But what is required to actually excel is not just capital also. Even if one is able to manage the availability of capital, you have to have the talent pool, you have to have the know-how, and this is where having strong multinational clients has benefited Windlas, because these clients have been working with us, doing audits. We get almost 70 to 80 audits a year. So almost every week, 1 or 2 audits are going on. So the compliance level automatically improves as a result of the.
Sorry, sir, you're not audible.
Are you able to hear me now?
Yes, sir. Please go ahead.
So I was just saying that so Schedule M compliance is not just about capital access to capital. It is about know-how. It is about talent, and it is about systems. How do we maintain whatever we, even if you achieve it once, then how do you stay compliant? It is an overall organizational capability building, and that is something that at least we are focusing on.
Just a follow-up on that, with this stringent regulation, do you feel that will we see a greater consolidation of industry in next 2-3 years, where smaller players will give in, there will be more shutdowns, and players like you will come and cater to this market?
Yeah, I think that is a very valid thing. Any fragmented industry having a strong regulatory pressure, it's like a textbook case for consolidation. So how does it play out? We don't know, but yeah, any fragmented industry with a strong regulatory pressure, quality or regulatory pressures is bound to have a pressure for consolidation.
So just one last question from my side. So since you have already incurred ESOPs for employees this year, will we see a lower wage hike going forward in FY27 and FY28?
In terms of the accounting impact, are you asking?
Yeah, like the cash impact, like employee benefit expenses, the base pay, would we see a lower increment on that portion of the pay?
Okay, so basically the ESOPs have been given to say 100 employees, and we have 1100 employees.
Yeah.
So we are not sure that we would let the ESOP, which is a long-term strategy for keeping the employees, not let them move out and motivate them for better results. That should affect the increment percent, which is a regular annual this thing. We don't think that we would see reductions there, and with the additional production, in fact, so we don't expect employee cost per se to go down. What we try to do is look at the overall picture, try to see where we can bring in more savings, more efficiencies, operational efficiencies. That we continue to do, and that is why even after so the total ESOP increase is not really reflected in the overall EBITDA reduction for the.
Ma'am, you're not audible. Okay. Thank you. We'll take our next question from the line of Samarth Nagpal from Suranu Family Office. Please go ahead.
Hi, Hitesh, Komal, congrats on a very stable set. I have only one question. So I think earlier we had a strategy or a long-term aspiration to grow our different verticals by 2x, 3x, and 4x. So looking at Windlas, we would hopefully be doing 1,000 CR by next financial year. So what is the long-term strategy if we look at 3 to 5 years down the line, or something we have on that front?
So there is long-term strategy internally. We just stopped giving that outside the organization. So we continue to strive to have a very strong internal growth strategies for.
Okay. So just deliberating on that, I mean, would we be looking at a faster pace of growth also after we do 1,000 crores, and what's the aspiration? Some color on that if you are able to provide, otherwise it's perfectly okay.
Yeah, we would rather try to surprise you pleasantly. That is the intent, and that is the effort, is what I can tell you. How we are able to execute defense here.
Okay, so that's it from my end. Thank you. Yeah.
Thank you. Next question is from Ankit Gupta from Bamboo Capital. Please go ahead.
Thanks for the opportunity. If you can, we are also looking at expanding the injectable plant. We are looking to put more flows on our existing injectable plant. So, like, we were earlier deliberating that we might do that by end of this financial year or starting next year. So, any updates on that?
No, actually, so what we had said was that, capacity expansion will follow the business needs, right? As we see utilization and as we see, need for expansion, we have the space and we will do that. And I think that it will be the same for like even oral solids. That's the way we are doing, and so injectable will also follow similar patterns.
Sure. So, given, the utilization for injectable has been lower than our expectations, but let's say by end of next financial year, let's say end of FY27, do we expect to ramp up to, 70-80% capacity utilization as of now? You have some visibility on that front, or currently it doesn't look like we'll be able to achieve that?
So we have some internal thought process and understanding, but the capacity utilization number is a very competitive number, right? Because when you disclose that, your competitors understand how desperate, and your customers also understand how desperate you are for business. So this is something that we have refrained from discussing on earnings calls.
Sure. And on the trade generics front, the earlier participant also spoke about it. We see some of our peers who have almost 2.5 times our size. They are also growing at a faster pace than us. So, has there been an increase in competitive intensity in this financial year that our rate of growth has reduced? I'm not talking about just this quarter. This quarter we grew at 8%, but even overall, given our base is hardly less than 200 crore for the full financial year, and we have grown at 18% for 9 months, but even earlier we used to grow at very high growth rates. So, what has been the reason for this lower growth, and how should we look at this segment growth going ahead in FY27-28?
So we have been asked in past quarters also that if in industry the other competitors are delivering such a low growth rate in this particular vertical, and what are you doing? How are you delivering a much higher rate? And obviously that keeps changing quarter to quarter, and there have been so honestly what a particular organization is able to deliver depends on several factors for that organization. So I wouldn't really respond to the question of why somebody else is able to deliver a higher percentage in one particular quarter. But we continue, so we have always consistently continued to say that we see huge growth potential in this vertical, and we maintain that, and we strive and want to do everything in our power to be able to execute and deliver good numbers.
But just
Ankit, I request you to join back the queue, please, as we have other participants.
That's a follow-up on what Komal said, so if you can just allow me. So, Komal, over a longer term, let's say over the next 2 to 3 years, can we expect to grow at 25-30% or higher in this segment, given our base is still very small compared to
now, before asking this, what my answer is going to be. So I would just fall true to your expectations and say that I would refrain from saying anything about the future, but we will try our best to deliver good numbers.
Can we go back to our past growth numbers here?
I want to actually, bring back the focus on the fact that, we have delivered 12 consecutive quarters of highest ever revenue. And our, also as a formulator who is manufacturing in CDMO, trade generics and exports, we have also felt and stated also that, an evaluation that is longer term focused and also as a whole is a better evaluation. because it doesn't is fall subject to sort of maybe patterns which are maybe hard to identify the root cause of.
Sure. Okay. Thank you.
Thank you. Next question is from the line of Kushal Goenka from Mangal Keshav Financials LLP. Please go ahead.
Yeah, thank you so much for taking my question.
Kushal, can you use your handset mode, please? Your audio is not very clear.
Yeah, hello. I'm in the handset mode. Hello?
Yeah, please go ahead.
Yeah, just a caveat before asking my question. I'm fairly new to this company. So, sir, I was just going through the 25-year journey of the company, so from 2001 to 2025. So we started our plant 1 in 2001, and currently we are about to commission plant 6. So I just want to understand your thinking behind the clock speed of our growth rate. Do you think the 25-year journey seems in a very good path, or do you think that was more of a learning phase? And how would you see, say, the next 5-10 years? And I'm like asking you because, like for example, if we want to reach say a 3,000 to 4,000 crore top line company, so do you think that the addition of plants and different businesses should be fast, as in the clock speed? And I'll just add my second question to this because I think this is somewhat related. So my second question is, how does the management look at very heavy capex, a high debt, not exactly a high debt, but a good amount of debt, because since we are a debt-free company, and also a big vision greater than the cash that we have? Or do we always try to maintain a debt-free company and not look at very heavy capex or acquisition? Yeah, that's my question.
So, in answer to your first question about the long-term trajectory or the arc of Windlas Biotech's birth and growth, right? I think that it is, the journey is probably most importantly defined by capability building. Because, when we are in a segment that is B2B, and especially in a highly regulated industry with a lot of quality parameters changing, every one has to focus on capability building, right? Whether you enter a new dosage form, or whether you enter into a new geographical market, or whether you enter into new kind of products that you're dealing. So my sense is that as an organization, if we focus on capability building and our execution skills, there is no upper ceiling on how we can grow, how fast we can grow. So there is no strategic cliff as such. What we have to do is execute. So that remains the challenge, and that's why high-performing teams, well-motivated people, everything is required. To your second question,
even on the first one, I want to add that we have been always, not being afraid of being the first movers. We were the first one to get a private equity investor in among Indian pharma CDMO players. We were the first one to go public, and there are several other things that we take pride in terms of going, being the first one to offer ESOP to our employees. So we keep pushing the envelope, even sometimes before others, even the bigger players than us do. So we have been doing that, and we continue to do that. So we don't see a limitation in terms of the kind of number that we can deliver and how early. So there's that limitation does not exist, because the biggest portion is oral solids, in which we have been building various plants. So increasing the plant is not, can never be a constraint. Bringing business is not a constraint, because we have a very good relationship with the customers that we have been working with, and we are also very good in terms of adding the customers. And in terms of bringing good people, we don't think that that can be an issue, because we also take pride in taking very good care of our employees in short and long term. So net, if you ask us, there's no limitation in terms of what we can do in near future or in long term, and we consider ourselves in a very good place where growth cannot be a constraint for us. Number one. In terms of being a high debt or high cash company, we in all the departments there is literacy in terms of financial discipline. That is what we take pride in, and we like to be cash rich, but we are not risk averse. So in past we have taken several debts for working capital and for capex, and for whenever we see an opportunity. So like if I have to do an acquisition, it's a very good strategic fit. I won't be shy in using my cash and also taking a debt. At the same time, if I'm not okay that for the regular business I lose control in operating working capital, that is how we go about it. In past we have done buyback where promoters did not participate because we saw an opportunity and we felt that this is a very good price for company to reduce the liquidity in the market. So every decision is a separate decision, not looked at wearing the glasses of being very risk averse or being okay losing some financial discipline. There is always this balance that we like to maintain.
Okay, just one follow up on the first one. So can we allude that the first 25 years was more like a learning phase, and the economies of learning and compounding effect can be seen in the next 5-10 years, and the clock speed and the rate of growth can increase going forward?
So, of course, we would love that, and we are always striving for that, right? We are not setting in, a target of growth and then shying away to exceed it. What I feel is, again, that every company has to evolve from the place they are standing and the situations that exist at that point in time. So some of our competitors who are very large, they made the risk calls of investing, almost close to 1,000 crores at the time they entered into the CDMO business. So, of course, we will also have to evaluate our own trajectories, and going back to what Komal said, the only right way and the only judicious way to build a business is to neither be risk averse and neither be, overly risk taking in terms of being callous about discipline. So we will have to, we will stay balanced, and we will continue to adapt, be flexible, be opportunistic, while staying disciplined and balanced. That's all that we can share.
Okay. Thank you so much.
Thank you.
Best of luck for the coming quarter.
Thank you.
We'll take our next question from the line of Sajal Kapoor from Anti-Fragile Thinking. Please go ahead.
Yeah, thanks. Hi, Hitesh and Komal. Appreciate the clarity on separating ESOPs from salary increments while addressing the earlier participant's question. Clearly, they are distinct levers, and not everyone benefits from ESOP scheme. It's only 100 employees. So thank you for clarifying that. I have two questions. Given finite manufacturing and management bandwidth, how are you balancing efforts between onboarding new customers and deepening engagements with the existing ones? That's my first question.
So, thank you, Sajal. What we are actually, how we manage it internally is, having two targets for everyone who's part of the business development team. So we have organized them horizontally than vertically. So there are several teams who have only specific existing customers and new customers. And internally we have regular dashboards being circulated in terms of the number of customers outreached in the existing customer portfolio, and the efforts taken on having new customers onboarded, and the business brought in from those customers. In fact, there is a third category also, the customers which are recently added in the last year. So how how's the mining happening against the new added customers which are comparatively new.
And this is aligned with senior level management visits with key clients, which includes visits and discussions by our joint MD, Mr. Manoj Windlas, who looks at handling the key client relationships, even our commercial head, and down the level. There is we are very conscious that this is not just a transaction. There is a relationship building, and based on there is sort of a beat at which each customer is looked at, and different levels of people are making travel visits, phone calls, performance review report cards. Some of our customers are initiating performance review report cards on regular basis. So those are also places where we discuss how to smoothen things and how to grow further. So this is very much the regular part of business development, strategy, planning, and execution.
Reassuring. Thank you for that. Second question is on trade generics and institutional business, right? I mean, if you look at the long-term CAGR, which is there in the presentation as well as the annual report, it's about 40-41%, which is about 5-year CAGR, right? But the last 3 months, only 7%. 18 months is 9 months is fine at 18%, but last 3 months, what changed so dramatically? Is it just a major institutional order slipping into the next quarter? Please, can you double click and help us understand the root cause of this significant slowdown in trade generics?
So, Sajal, see, one is that as we mentioned that in the past also there have been slow quarters and there have been strong growth. We have also discussed that from more and more people are jumping into trade generics. So the competitive landscape is also there. And the third aspect is about the lumpiness of institutional business, right? Some tenders get captured within the quarter, some don't. And of course our own execution on the ground. So that sort of set of things is what we have to play with. There are not many more levers than that. What geographies you operate in, what products, and what client base you're working with, because it's a large number of SKUs being sold, right? So there is not really something that is further beyond that. So we have to just focus on execution.
Yeah. So what I'm hearing is that 40% is an aberration, but so is 7%. What is the more sustainable medium-term CAGR then?
I think that, so look, I mean, the way from, if you look at the largest company in this segment, right, Lee Ford, when they came into market, they had a period of, experimentation. They almost wrapped up and then launched again. And then within 10 years, built it into a 2,000 crore business. So I think that really it's not about whether I can retrospectively attribute a good CAGR to this, Sajalji. It is more about how my, time to time actions are and how I reinforce this, strong tempo and culture of building. And of course, there will be always some challenges and we will have to figure out the new challenges. I don't know if I can add any more commentary on the numbers specifically.
Sure, sure. No, that's helpful. Thank you so much and all the very best.
Thank you.
Thank you. Ladies and gentlemen, we'll take that as the last question for today. I now hand the conference over to the management for closing comments. Over to you.
Thank you very much, everyone. Looking forward to seeing you next quarter.
Thank you. On behalf of Windlas Biotech Ltd, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.